go. The top 5 reasons why interest rates not only could be in the 5s in 2024, but they actually should be in the 5s in 2024. Now, as you know, we hear in all of the newspapers, we hear all over the news, we hear everywhere that rates are dropping, rates are dropping, rates are dropping. That's great to hear, but is it really moving our market yet? And what we want to know is, how do we get this this movement to actually trickle into the market and make our clients realize that now is either the time to get off the fence and buy, as we all know, before rates go up, or I'm sorry, before pricing goes up, or to make sure that they're ready to list so that we have more housing inventory. So with that, I'm going to start off. I'm going to tell you that there's going to be a lot of charts in this. And I like to say that I like to talk at a kindergarten level because that's how I learn. So don't get afraid of the charts, because we are going to explain them as easily as we possibly can. I don't like to say we dumb things down. I like to say that we like to put the cookie jar on the bottom shelf, because that way it doesn't make it sound like that we are dumb, because we're not. We're just trying to make it easier to understand, because my hope is that if you understand it, then your client will also understand it when you try to explain it to them. So before we start out, what we all have to understand is we have to understand the economic business cycle. We have to know how the business cycle works. It doesn't matter whether it's the mortgage cycle, whether it's the economic cycle, whether it's the GDP, whatever it is. The way that the business cycle always works always consists of the 4 different phases. Sometimes they add some, they subtract some, but consistently it's 4 different phases. There's a boom or an expansion. There's a peak there, which is always going to be followed by either a recession, but it doesn't have to be called a recession. We might know that as a contraction, which will then drop us down to a trough and return with a recovery. So those are the 4 different business cycles that we have to understand, that every economy is going to go through these 4 different sessions, and we keep going through them over and over and over again. So as we're going through what we're going to talk about today, I would really hope that you would consider, where are we right now? Because that's going to be a great way for you to let your customers remind them when they're trying to figure out what they want to do, remind them where we are in the business cycle. So the first reason, number 1, as why I think rates are going to be in the 5s this year, has to do with the yield curve and the recession. So the yield curve, we have to, in order to understand the yield curve, we have to understand what the Treasury is. So the 10-year Treasury is an important thing for everyone to watch when they're analyzing trends in the market, or what interest rates are going to be doing. Most analysts watch the 10-year Treasury by looking at the 10-year Treasury note or bills, or they might call them the 10-year bond. So the 10-year Treasury is the interest rate, the 10-year Treasury yield is the interest rate that is paid by the US government on a debt with a maturity of 10 years. So basically this debt is put out to auction, and then as an investment, you can buy that debt for a certain interest rate to be paid to you. So your money is given to the government. The interest rate is then determined depending upon which treasury you're going to buy. It's then you're going to be making that interest rate back on that investment, and that bond is created through the debt that the US has gone out and got itself into. So it's a benchmark for all financial instruments, and can be used as an as an indicator of the overall economic condition. So what you need to know is that a yield increase, now remember, yield is the interest rate that is paid on the treasury. So you might want to write that down, because you do have to know that the yield on the treasury, because when we talk later, we're going to talk about price, which is different, but the yield on the treasury is going to equal interest rate paid. So the yield, if there's an increase in the yield, that means that the market has confidence in the economy. If there's a decrease in the yield, the economy is kind of uncertain, which means that there's a flight, they want a flight to safety. Okay, so when someone invests in that, there's a flight to safety when they invest in the treasury. Now, what the yield curve, everybody talks about the yield curve, but who actually knows what a yield curve is? We all talk about it in theory. We hear it we talk about it on the news. We read about it, but very few people understand what a yield curve actually is. So to break it down, you just have an axis, which is just dots plotted out on this axis. The y-axis is, it charts the interest rate or the yield of that bond or the treasury. So let's say if the yield that's paying out on the treasury is 3%, then you would plot out 3%. But the y or the x-axis charts how long the maturity of that treasury is. So if we are looking at the yield curve of a 10-year treasury, you can see that the treasury yield of the 10-year would be a longer term maturity. If you're looking at a 30-year yield or a 30-year treasury, you're going to be looking at an even longer maturity. But there are also bonds and securities and things that are like 3 months, 5 months, a year, 5 years. So there are all these different maturities of these treasury securities that you can buy that go along this x-axis, charting how long that maturity is. The y, again, or the y-axis is going to chart the yield or the rate paid. So the longer it takes a bond to mature, the higher typically the yield is. So that's why you see a curve that goes along like this, because the shorter the maturity, the lower the rate, the longer the maturity, the higher the rate. Think of it like this. Do you get a higher interest rate on a 15-year loan or a lower interest rate versus a 30? Well, 15 years is shorter, so typically people get 15-year loans hoping that they're going to get a lower interest rate. So just kind of think of it that way. That is what a yield curve is. It's just the dots plotted along the graph showing what rates are versus the maturity length of that yield or of that treasury. The reason why we need to know that is because of this. And the whole purpose of everything we've talked about so far is because we need to understand what the inverted yield curve is. The inverted yield curve is what is going on in our market right now. So an inverted yield curve says, rather than having a shorter term interest rate or a shorter term maturity that is should normally have a lower interest rate and go this way because the interest rate should be higher as we go out in maturity, it starts the other way. The interest rate is higher in the beginning or in the shorter term maturities, and the rates trend to go down on the longer term. So if rates start at a higher, start high and then they decrease as the bond matures, it shows that long-term investors believe that rates are on their way down. And so remember, if lower rates are on these bonds lower rates on these bonds tend to indicate that there are economic slowdowns coming. So an inverted yield curve often are signs of impending recessions. That is the whole point of understanding why the inverted yield curve is so important. So if you remember, the recession is another part of the business cycle. What this chart shows, the reason why inverted yield curves are so important is this chart shows over time, from all the way back from 1977 to 2021, the gray areas in the back are recession periods. So these are all areas of recessions. And if you look at all these crazy colored lines, each one of them is a yield curve based upon different spreads. So they compare different maturities of treasuries. They compare like a 5-year and a 3-month, a 10-year to a 1-year, a 1-year to a 3-month. All they're doing is comparing the spreads between different lengths of maturities. This zero axis line is where the inverted yield starts. Anything below zero is going to be an inverted yield curve. So if you notice, even when just one of these spreads happen, when they go inverted, what happens? What is it predicting? What are you seeing that happens after these yield curves go inverted? They precede every single one of these recessions. So it's a very good indicator that the recession is coming when you see inverted yield curves. So what's crazy about this is if you look and see just one or two of these spreads when they go inverted, it still always precedes a recession. But look what happens when all of them go inverted. You can see how big the recessions are. And if you look at now, what do we see? All of these spreads are inverted. So we know that we are heading into a contraction or a recessionary period. So, number 2, the Fed and rate cuts. Everybody's talking about the Fed and rate cuts. Monetary policy is determined by the Fed. And at its peak, the Fed will slow or reduce interest rates. So remember, in our business cycle, every cycle goes through these different processes. And at the peak, in order to slow the increase in our economy, the Fed starts pumping the brakes on interest rates. That in that way, that it slows down people's spending. So when things are good, the Fed starts raising rates. It's kind of like tapping on the brakes of the economy. And so if you look here, this was prior to COVID. You know, we're going along, everything's fine. Then COVID hits. Well, that's going to, because it was very it was very much a recession, and it happened very, very fast. The Fed responded very quickly and dropped rates. That the whole purpose of that was to spur the economy. So it kept rates really, 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 really low to keep the economy going. But then as the economy recovered in 2022, rather than tapping on the brakes, you can see that the Fed literally pushed on they slammed on the brakes. They couldn't slam on the brakes probably any harder than they did. So the question is, are we at the peak of the Fed ending that increase? Well, as the economy slows, which we can all agree that the economy is starting to slow, people stop spending as much money. And the Fed at that point will start reducing interest rates because, again, the next process in the business cycle is to help kickstart spending and investment to boost the economy. So if you look back at this chart and you see that the economy has been slowed, you can see that we are in need of getting a little bit of a kickstart back to get the economy moving again, which the Fed will do through by reducing the interest rates. Now, what's interesting is And what the question that most people are wondering is, when are they going to start reducing rates? Because even though they are short-term rates, the Fed has direct results with short-term interest rates. Long-term rates tend to trend with those short-term interest rates. So the question is, now that the Fed has stopped has the Fed stopped the hiking, to see when they will start dropping rates. So if you look back over time and look at the cycle of when the Fed has increased rates over the past, however many years, 30 years, every time the Fed has stopped hiking rates, there's been a slight pause before they start decreasing rates again. And if you look over modern times, one time it was 4 months, one time it was 5 months, one time it was 8 months, 15 months, 7 months. You can see how long that pause is before they start decreasing interest rates. And if you average up those, the average is about 5 months before the Fed starts decreasing interest rates. So with that in mind, I don't know if anybody's paying attention or not, but the last interest rate hike by the Fed happened at the July 27th Fed Open Market Committee meeting. And guess when 5 months is going to be? Well, the January Fed meeting, which will happen at the end of January, that will be 5 months. So based upon what was said at the December meeting, by what the Fed said in their commentary, it changed a lot of perspectives from analysts because of where they were directing their comments about starting the decrease in interest rates. So after the Fair Market Committee meeting in December, analysts from both Bank of America and Goldman Sachs, they revised their predictions for future Fed cuts, with their expectations beginning that they expect rates to start dropping at the March 2024 meeting. That is literally in 2 to 3 months. So if you start thinking about that, the Fed starting to drop the interest rates on short-term rates, that is going to start the decline of the short-term interest rate drops. So B of A says that on Monday, it expects the Federal Reserve to deliver a 4 25 basis point rate cuts in the next year, starting in March. That's 100 basis points for 2024 that they're expecting the Fed to drop rates. Goldman Sachs is forecasting that the Fed will slash rates by 25 basis points at least 3 times in a row between March and June, and then ease twice more over the second half of the year. So that's 5 times that Goldman Sachs is saying that they think that the Fed's going to drop interest rates. So that's pretty fascinating that we are going to see that the Fed is literally indicating that they are going to start dropping rates as early as March. So that leads us to quantitative easing, quantitative tightening, and the Fed balance sheet, which I know that sounds so exciting that you're just wanting to jump up and down right now, but I promise we're going to make it a little bit easier to understand. But for you to understand this, you have to understand a little bit more about the Treasury. And this is where I would suggest you write down this, because it gets confusing for the best of us. And in order to understand how the 10-year Treasury works, you have to remember that the price of the 10-year Treasury is different than the yield, okay? So when we start talking about tracking the 10-year Treasury, because, and we'll talk about that in a minute, you have to understand, are we tracking price or are we tracking yield? Because those are exact opposite things. So if you understand what the 10-year Treasury is it's basically an investment that you can invest in, and there's a set interest rate or a set yield that Treasury or that investment is going to pay you back over time, whatever time frame that you buy that treasury for. Remember the maturity of that treasury. Is it a 3-month treasury? Is it a 5-month treasury? Is it a 10-year treasury? Whatever. You're going to be paid back that interest rate or yield that you've decided to purchase. Now, how you decide which yield, I mean, why wouldn't you just go out and pay? I mean, why wouldn't you buy the highest interest rate or highest yielding treasury that you can? Well, the problem is that there's a price. You have to pay a price for purchasing that treasury. The price is going to be inverse to the yield. So as prices go up, so as the price of that treasury goes up, the yield or what it's paying you back is going to go down. Okay, so as the yield goes up, so when we talk yield, you could replace the term yield with interest or the interest rate. So what I would write down is the treasury price is what the investors are willing to pay for the price of that bond or treasury in the market. And the yield, the treasury yield, is you could say could be replaced with interest rate. Okay. And it's an inverse relationship. You just need to remember that. So as price goes up, yield goes down. So again, looking at the economic business cycle, let's now try to figure out again, where are we in the economic business cycle? We've learned about what's gone on in the past, why the Fed's doing what they're doing, when they're going to do it. So where are we in the cycle? Well, if you remember, COVID struck and it slowed the economy. So in order to keep the economy moving, the Fed, to get us out of that somewhat recession, the Fed drastically reduced interest rate to give the economy a boost. So we were right here. Then the Fed, in order for the Fed, if you remember, the Fed's interest rates weren't super high to begin with. So they didn't have a whole lot of room to drop interest rates to get us out of the recession just based on interest rate alone. And so in order to help with monetary policy, the Fed also drastically wanted to boost the economy, and they did it through a thing called QE, or quantitative easing. So we're going to talk about that is in a second. But through quantitative easing, they bought over $100 billion in securities in the month of March. They bought that $100 billion every day in the month of March and increased its balance sheet by $4 trillion in 2 years. So let's just think about what that means. If I have, imagine if we're looking at the Phoenix real estate market and you had a big giant investor like, I don't know, Blackstone, that came in and decided to buy up 100 properties a day or even 1,000 properties a day in the Phoenix market every day for a month. What would that do to the remaining value of the homes that would be going on the market? It would drop inventory. And so the remaining inventory, because there is a lack of inventory for the other people that want to buy besides Blackstone or the big investor, it would probably do exactly what it did during COVID when we had a lack of inventory. It shoots prices up, right? Because if you have a very low supply, you can increase the price of that supply to meet, because the demand is there for the low supply. So if the Fed is the biggest purchaser of all the bonds that were in the market, and they just kept buying these bonds back up, and so there weren't as many bonds in the market, the price of those bonds kept going up. Well, if you remember, if price is high, what the inverse of that is yield, which means that the interest rate or yield was low, right? So if you remember, during that recovery time frame, interest rates were low, which is why they did that. So that was their way to boost the economy. But they added $2 trillion in debt to their balance sheet. $2 trillion of that mortgage-backed security market got added to their balance sheet in a very short period of time. So by May of 2022, the Fed says, we're going to stop purchasing mortgage bonds because, first of all, we've got this inflation issue now because the prices are so high because there's no inventory. And remember, we also had the whole supply chain issue. Prices on everything were going up, right? So the Fed says, okay, in May of 2022, we're going to stop purchasing mortgage-backed securities and treasuries. But not only that, we're also going to let what we have on our balance sheet back into the market. So that is what's known as quantitative tightening, or Q2. So not only is it going to, they're going to stop buying up all these bonds and treasuries in the market, they're going to release all of these bonds and treasuries that they already hold back into the market. So what happens when you flood the market with more supply? Well, prices go down. And if the price of the treasury goes down, if it's inverse to the yield then goes up, and yield equals interest rates. So we had interest rates starting to go up. So by reducing the price of mortgage-backed securities and flooding the market with excess securities, there's a direct impact on interest rates, as the yield must increase to attract investors, which will then slow the economy. So in order for, if our biggest purchaser of mortgage-backed securities and treasury, which is the government, stops buying, we've got to somehow attract more buyers. So how do you do that? Well, if I want to go and buy a bond, am I going to want to buy it at 2% return on my money? Do I want to give $100,000 and get a 2% return for 30 years? Well, no. You're going to have to entice me by paying, maybe you'll pay me 8% for 30 years. So you increase my yield to entice me back into the market. Well, that's what is going on right now. So right now we are in this part of the business cycle, because that's what's going on right now. We've reached this quantitative tightening, which is now the balance sheet of the Fed has now increased so dramatically that they're now putting it back into the market and flooding the market. And in fact, if you look at what the balance sheet is of the Fed, if you look at what it was pre-COVID, the Fed held about $4.25 billion on their balance sheet prior to 2018. It went up a little bit pre-COVID, but look at it, it doubled, almost doubled during that quantitative easing. That scared the Fed a lot. And in fact, if you look at how much of a percentage of those mortgage-backed securities is of gross domestic product, it's a 33% increase, or it's a 33% of GDP, which is of just holding their own debt. So that's freaked out the Fed for sure. So just kind of back into and explaining quantitative easing, that's when the Fed's going to buy trillions in mortgage-backed securities. That is a form of the monetary policy that helps with lowering interest rates to get the market moving, to help people to keep interest rates low and get people spending money. So quantitative easing, that's all it means, is that the Fed is out buying treasuries and mortgage-backed securities every month, which reduces the supply of mortgage-backed securities and treasuries in the market, but it puts it back onto their balance sheet, which is making the Fed's debt substantial. So if you look here, you can see already from the time that they decided to do this, May of 2022 to now, they've already dropped about $1.7 trillion of mortgage-backed securities and treasuries back into the market and got them off their balance sheet. Which has dropped the balance sheet down to about 25% of GDP, which is good, but it's about 3%, still within about 3% of what it was pre-COVID. So you can probably see that over the next few months, they're probably going to want to target that 22% range through the tightening, which is them stopping buying that and flooding the market. So over the next few months, they're slowly going to just let that those bonds that they're holding back into the market. But about May, June area, they're not going to really release any of that back into the market. So what's that going to do to the mortgage-backed security price? It's going to level out. Now remember, this is classic supply and demand. If you don't have as much supply in the market, you have a higher price. And remember, per your notes, higher price equals lower yield, and yield is lower interest rates. So by the mid-June, you can see they basically, if they continue at the pace that they're going, by about mid-June, they will have released back probably the majority of what they're going to put back into the market off of their balance sheet. So, and what we've already seen is that the reason why we know that this is going on is that investors and traders have watched bankers who like the Treasury bill. They like that high interest rate because they want to invest in that. So they've already started buying up all of those high 8% Treasury bonds. They're buying them up out of the market, which is reducing supply even more, which is compounding that, which is starting to make rates drop already because they want those bonds for a long period with that high interest rate. So compounding all that together, we come to reason number 4. And reason number 4 is the 10-year spread. Everybody talks about the Treasury and its comparison to the 30-year fixed rate mortgage. Now, the 30-year fixed rate mortgage is this green line, and this dark green line, and then the 10-year Treasury is this light green line. So you can see, I mean, if you were to line them up together, I mean, it would almost match, I'm saying almost match right on each other. But it's not matched because there is always typically about a 1 to 2% spread difference between the Treasury, what the price of the Treasury is, or the yield of the Treasury and the yield of the mortgage-backed security. The reason for that is they're very similar. I mean, they're very similar bonds. They are both long-term, and they both have very relatively stable risk. The difference is mortgages have that human factor in it. The Treasury is just government. So you add that human factor and you add human risk to it. So on average, investors add about, over time, as you can see, they've always added about 1 to 2% on top of the Treasury for that added risk, which just means that it's a higher rate of return if you want to invest in that security or bond versus a treasury bond. So you are basically looking at interest rates tracking the 10-year treasury over the life of, or the last 50 years, whatever it is. And almost always they track right alongside. The only time they differ, if you look, is right along times of recession. And that's when the spread typically widens. And there's a reason for that. So when is the spread abnormal? So we said that the normal spread is typically between 1 to 2% traditionally. So that 1 to 2% is basically 100 to 200 basis points difference between the two treasuries or the two securities. So why did this happen? Why were there the spread difference at the different recession timeframes? In 2009, it was the housing crisis. Well, that was because there was a sharp tightening of credit conditions, and then there were significant disruptions in the financial markets that funded mortgages. Again, the human error. So the human error created a much larger spread between the treasury and the 30-year fixed rate mortgage. So it was almost 3% spread rather than 1 to 2. Then if you look at 2020, the COVID era, the COVID-19 pandemic, you are looking at almost a 2.7% spread. Well, it's because there were shorter disruptions in the financial markets, with supply chain issues, the issues about people losing their jobs all the time. If you remember when we had to verify people's employments like 72 times during the loan process, that was fun times. When there was just, you never knew if anybody had a job by the end of the closing period. There were all sorts of disruptions that were short-lived among lenders and investors on those mortgage assets. And then you throw in the government creating new programs. They created all those forbearance issues or the forbearance programs that created problems for mortgage lenders in making sure that they were receiving mortgage payments. Then you also had all the bond creation by the government because they were creating, they were sending those COVID checks to borrowers. Well, all of that had to be funded by bonds. So there were all sorts of things that created that increase in the spread. But so now, why do you think it would be that we are at a 300 basis point spread right now? Well, number one, because we are about ready to enter into a recession, as we've already discussed. But there's a new reason, a new issue, which has to do with that first topic we talked about, which was the inverted yield curve. That issue that short-term interest rates are higher than long-term interest rates. We're coming out of a market where short-term rates or long-term rates were very, very, very low. And then the Fed drastically increased short-term rates. And so we had long-term rates that were in the 2s and 3s and short-term rates that are now in the 8s, right? So we have this inverted yield curve very quickly, and investors are looking at this and saying, now, wait a minute, if I'm going to go and buy a mortgage-backed security right now, I'm going to have this additional risk that says, if I'm in an inverted yield curve and I know that the short terms are at a much higher rate than the long terms, and I know we're heading into a recession, so I know short-term rates are going to go down and long-term rates are, I know that long-term rates will start coming down after, as the short-term rates start coming down. Do I really want to buy a bond or a mortgage-backed security that has the human factor that says that borrower has the ability to refinance that loan anytime they want and pay me off. And so I don't get that full benefit of that security that I purchased. So we call that prepayment risk. So there's this prepayment risk that says, do I really want to go out and buy a long-term interest rate bond when I know it's going to prepay a lot sooner than what the cost of buying that bond will be? And so that prepayment risk has really increased that spread, and which has made it be in the 300% range, or 300 basis point range, rather than the 100 and 200 range. So investors know that mortgage rates are going to fall, and people have the ability to refinance or pay off their mortgages early. And so there's an additional risk there in mortgage-backed securities that the Treasury does not have. So that spread has widened. So what we see now is that as rates start to normalize, or the spread starts to normalize, which we are already starting to see, because we know that the Fed is going to start dropping rates. We've seen that rates are starting to come down. In fact, the current spread, as you can see in this chart, has already started going down for 8 straight weeks, and is at its lowest point that it's been since March. We know that that spread is going to start coming down. So if you look at this chart, this is the differential between the 30-year fixed rate mortgage and the 10-year Treasury. So we said that it typically is between 1 to 2%. The spread typically trades somewhere between this range. But right now, we've been trading in this range, that huge spread. But we're starting to see it come down. So if we look at interest rates, and we look at, let's just take December 27th, for example. If the 10-year Treasury index, or the 10-year Treasury rate, was 3.79, if you add the spread, which was 2.75, you would get an interest rate of 6.54. And if I don't know if anybody listened to the news over the holidays, but it just so happened that the news said, guess what? Rates came down. They're in the mid 6s. Well, it's because the spread is coming down. So again, let's look at a couple scenarios as to why I think rates are going to be in the 5s. The Treasury is going to hit a lower trend line. So the Treasury, there are certain trend lines that we're going to talk about in the next section that it will hit. And one of those trend lines is at 3.46, and it's called the Fibonacci number, which we won't get into, but there is a trend line at 3.46 where the Treasury is anticipated to go, barring any natural disaster, war, act of God, all those things. But if you were to take a more natural spread, say not even 200 basis points or 2%, let's call it 2.25, okay? If you take the Treasury, if it were to go from 3.59 or 3.79 to 3.46 and add those two together, you've got an interest rate that's at 5.71%. So you've got rates right there in the 5s. Now let's talk about what we said when we talked about the Fed dropping the short-term rates. So if the Treasury, if your Treasury bill drops 75 basis points, more in line with what the Fed says they're going to do, or what people anticipate the Fed doing in the next 12 months, and that if we took the Treasury down 75 basis points to 3%, and you put that more natural 2.25% spread, you now have rates at 5.25%. So you will see rates, again, barring acts of God, war, a COVID pandemic, all of those things that you can't forecast, you will see as things start moving through the economic business cycle that the spread and the Treasury, as it comes down, that we will naturally see rates in the 5s. Now, all the spread does is accelerate that happening. And finally, the coup de grace, the charts. So I spend a lot of time during the day looking at candlestick charts. This isn't like crazy hard to understand. All you have to know about is that this is the chart that tracks mortgage-backed securities. The only thing that says what mortgage rates are doing or have done is the mortgage-backed security market, is the mortgage-backed security. This is the 30-year mortgage-backed security over the last month. This is the actual chart of what a 30-year mortgage-backed security bond chart looks like. So in order to understand what you're looking at on a mortgage-backed security chart, you have to understand what these things are. These are called candlesticks. And on a candlestick or on a chart, each candlestick represents a day of trading, okay? And you would see this on a stock market chart, you'd see it on a bond market chart, but this happens to be a mortgage-backed security chart. So it's a visual, each candlestick is a visual representation of all of the price movements of the financial markets in a day. They illustrate the open, the high, the low, and the close prices for that day's event. Now the body, so the body of the candle is this thick section. That is the price of the open and the close of the day's trading. So whatever the price was when the trading opened, sets one part of the body, and whatever the price was for the closing sets the other part of the body. Now, what color it is filled in with is determined as to whether the close price was higher than the open price or whether the close price was lower than the open price. So if the color was, or if the price opened higher, if the close price is higher than the open price, it's a green candlestick. If it's lower, then it's a red candlestick. Then the wicks, these lines right here, that is just the highest price, and then the lowest price during the period. So during the day. So this is the highest price that it got to. That's the lowest price that it got to during the trading during the day. So each day we look at these candlesticks and says, oh, this is this had a big swing. Wow. Oh, there wasn't much going on today. And we just look at every day's price. But that's not all we look at. So this is actually over the last quarter. This was a chart for the last quarter, because we also look for things called trends. We always track trends. And we look at two major trends called daily moving averages, or DMAs. We have the 200 daily moving average, or the 200 DMA. The 200-day moving average is the average price of that mortgage-backed security over the past 200 trading days. So for the 200-day moving average, that is that blue line right here. All that's doing is tracking trading over the last 200 trading days. And it's going to give us what's called a trend line, okay? Then that trend, all it does is it smooths out the short-term price fluctuations and identifies a direction of the trend. So is it going up? Is it going down? But that's a longer term trend line. Now the 50-day moving average is the same thing. It's just another trend line that smooths out the security prices over the last 50 trading days. And it's more of a shorter term trend line, okay? Shorter, so the 50-day moving average is this black line. But what we really are looking for, I mean, you can see how it kind of tracks, and you're seeing the movements of that. But what's interesting is technical symbols. Now, I always struggle with this, the bears and the bulls and all that stuff. But my husband actually told me something, and it made it really easy for me to remember now. Because my daughter goes to U of A, and they always say bear down. So bear is a downward trend. So there you go. I got a new way to remember it. So a bear movement is a downward movement. It's keeping things down. Bull is moving things up. Okay. So when we're looking at, and this is my favorite technical symbol ever, because it's called the death cross. I mean, how much more dramatic can you get? So this technical symbol called the death cross occurs when the short-term moving average, which is this 50-day line, crosses the long term. So it crosses the 200-day moving average. And the reason why it's the death cross, which kind of is foreshadowing if you haven't figured that out, is the short term basically is trending downward, which means, remember what downward means? Down in price. Remember, we're tracking price. So this is price. If we're moving down in price, what are interest rates doing? Are they going up or down? Well, if price is inverse to yield and yield equals interest rate, interest rates are, if price is going down, interest rates are going up. So this 50-day moving average short-term line crosses the blue line, which is the long-term line, and it basically is going down. The prices are going down, which means rates are going up. Now, if you look at this, this was our highest peak of interest rates in October of 23. And you can see that this was a very significant trend for the price to go down or rates to go up. But the importance of the death cross is that it's super significant because it indicates a significant shift in trends. It basically says we're going to have a much longer trend in this direction than just a little fluctuation. And that's why the death cross is a significant trend. But when you've got a negative trend, you also have a positive trend. And this is the golden cross. So the golden cross is going to be basically the opposite. It's going to be when the black 50-day moving average crosses over the longer term trend of the 200-day moving average, which means it's going upwards and prices are going up. So prices going up mean yield is going down, rates are going down. It's significant again because it's a shift in the short-term trend reflecting buying pressure and strength of that security, which suggests that that they should take a buying stance, which means they should continue to buy. Prices are going up. Look at what's going to happen. So we've had our death cross. Now, remember that this is a pivot where the trend is going to show us that this is a longer term trend, not just a short trend. And so if you were to look at this point, look at how close we are to the golden cross. where do you think that golden cross is going to cross that, or where do you think the 50-day moving average is going to cross that 200-day moving average? Well, if we look at our months, I would say we're going to start seeing that January, February, maybe March, which also coincides with what? When does the Fed start dropping interest rates? When do we start seeing all the mortgage-backed securities getting being halted, from being pushed into the market? Okay, that is going to indicate a much stronger trend for lower rates. So those are my 5 reasons. We've got the inverted yield curve, which is predicting the recession. We've got the Fed and their rate cuts. We've got the quantitative easing and tightening, and then the Fed's balance sheet. We've got that mortgage spread in the 10-year Treasury. And then, of course, we've got, the death cross and the golden cross, which we're seeing in the charts. Those are my top 5 reasons why I think interest rates are going to be in the 5s in 2024. Now, I do have to tell you, I am not a financial analyst. This is just my reasoning. I could be totally wrong, but I do like to look at history to predict the future, and I think we've got a strong case for it. But these are the reasons why I see it happening. So I do appreciate you guys coming. I am very cognizant of your time, and I will, for everyone that has attended, I will be sending you out a PDF version for you to have of this that will go into details of everything that we talked about, so you can review this with notes, and then also give you something that you can use for your customers so that you can talk to them about this as well, to give them reasons to be moving off of the fence now, because we all know what happens when rates go down. You're going to see people, you are going to see people listing their homes and things like that. So I do hope that you will join me in 2 weeks from now to talk about the top 5 probate questions that you need answers now, and with my friend who is a probate attorney. And invite your friends. And if you have any questions at all for me, please let me know. And thanks again for showing up. We'll talk to you soon.